Friends, in this podcast, I'm going to talk to you about putting risk management first. For a long time, we have been seeing investors come to equity, believe more in the asset class, take more risks, show more faith in their allocations towards equity, and demonstrably show hunger for scale. This has been our trend for the last several years, and this trend has definitely created adequate asset allocation towards equity in most of our portfolios. I would even say that people have underallocated money to other asset classes in the last few years and allocated more money to equities. The reason behind this rise in conviction has been the spectacular performance of equity from the period 2013 to the period 2017. From the lows of 2013 to the highs of 2017, we saw equity creating a lot of returns. Even after 2017, we saw the Nifty creating very good returns while the broader market was not giving any returns. Both these trends reinforce the belief in people that they should show higher conviction in equity. Well, I have been a lifelong believer in equity. Seeing several cycles gives me a clear conviction that it is not enough to only show high conviction in one asset class. I think it is very important to follow a more nuanced and a balanced approach towards our investing. The entire process of our investing needs to become more holistic. And what better time to make it holistic than at a time when markets are going through turmoil and we are getting different opportunities to invest. When I say holistic, how can somebody change their investing at a time when stock markets are probably very close to their lows, when interest rates are probably again very close to their lows, the cash levels in our investment books are very close to their lows, and real estate prices are clearly very close to their lows. Starting from the lows, should we even bother? This is the question many people always ask when they are told to look closely at their financial planning and their risk management. From my experience, I can vouch that taking a look at this at the bottom of the cycle always helped me to emerge stronger when the cycle got better. When you postpone this decision to a point in the economic cycle where things are very good, your options are limited. Whereas when you are able to make this progression towards better risk management, when all asset classes are very close to their lows, your options are more. And you also have cash with you, however limited it may be, and the option of future cash flows as the economy progresses from the lows of the present to a better place in the future. That time between now and a better place is an invaluable resource in transforming our personal finances. So the best time to start risk management or to improve risk management or to take risk management to the next level, depending upon where you are, you can do one of these three things. The best time to start is probably closer to the lows of a market cycle, and that time clearly is around now. I would not dismiss the issues related to the coronavirus as temporary. We have a history of economic issues, and we are not going to walk out of this history in double quick time. While we could have a rally in assets for a brief period of time, you will see asset prices once again align to economic realities much faster than we expect. Therefore, with the broad acceptance that asset prices are always constantly realigned to economic realities, let us use this crisis in asset prices to rethink our risk management, to start afresh, to take our risk management to the next level, and to constantly create a culture of improving the way we face and manage our risks. So in that sense, the current crisis is a great opportunity for each of us to improve our risk management and to enjoy the benefits of that improvement over the next several years. For those who never really bothered much about risk management or are more driven by returns alone, this is a rare opportunity to go back to the drawing board, to redraw the lines, to create a systematic approach and to follow that approach into better times and prosperity. The start of a well-constructed, carefully curated and thought through journey towards prosperity has to be now. Happy investing. Keep watching our blog. Thank you very much.